Hello everyone. In this video, I would like to discuss our Global Economy Monitor October 2024 edition, where we examine key global economic risks, the global outlook, and major regions like the US, Eurozone, and China. We aim to assess these risks and explore what they could imply for global growth. This effort was a collaborative one between the Better Policy Project, the Central Bank of Armenia, and the National Bank of Georgia, where we produced our version of the World Economic Outlook. Our analysis follows a risk management approach, FPES Mark II, which means we start by examining what is priced into financial markets and baseline expectations from forecasters, forming what we call the market reference scenario, a macro-consistent baseline. We then consider what could go wrong by identifying global risks and constructing alternative scenarios. We outline two cases, Case A, which is a more hawkish scenario, and Case B, which is more dovish for central banks. The central narrative for the global economic outlook is one of a soft landing. This means that real growth is expected to moderate around its potential without tipping into a recession, while inflation should also decline gradually toward target levels. For monetary policy, this implies a gradual reduction in policy rates toward a neutral stance. Fiscal policy, meanwhile, is expected to normalize deficits in a way consistent with debt sustainability, although this remains a significant question. We should consider whether the soft landing scenario is feasible or if markets are underpricing risks. Historically, episodes of low risk perception, such as before the tech bust and the global financial crisis, indicate that such underpricing can itself be a significant risk. Our Case A scenario considers inflationary risks, which could be driven by a robust US economy, leading to excess demand pressures. There is also the potential for an escalation in the Middle East conflict, causing an oil price surge. In contrast, Case B describes a deflationary risk scenario triggered by weaknesses in China's property market and Eurozone stagnation. These could spill over globally, leading to an economic slowdown, stock market corrections in the US, and a more dovish response from central banks. Now let's look at country-specific cases. Starting with the US, we use a monthly projection model following Duncan's approach. This involves first constructing economic narratives based on current trends and forces, and then quantifying them using the model. The soft landing scenario for the US projects a gradual decline in inflation, a moderation of excess demand, and unemployment easing toward a long-term average. Policy rates are expected to gradually decrease to a neutral rate of 3.6%, but risks remain. US economic growth has been driven primarily by consumption, which has remained strong over several quarters. Despite revisions downward for Q4 growth estimates to around 2.3%, consumption remains resilient. This resilience is partly due to increases in household net worth, fueled by a strong stock market driven by developments like AI advancements. However, we must also acknowledge the potential for asset price bubbles if these gains are not fully supported by fundamentals. The labor market outlook is mixed. Although there has been some cooling, wage growth remains elevated at around 4.7%, above what is consistent with a 2% inflation target. As a result, inflationary pressures persist, particularly evident in measures of underlying inflation, like sticky price inflation. While headline inflation numbers have moderated, largely due to energy price normalization, core measures such as PCE inflation remain elevated. Market expectations for monetary policy still favor a gradual path toward rate cuts. However, the risk remains that inflation may not subside quickly enough, requiring a more aggressive policy stance. Alternatively, in our Case B scenario, global economic weakness could force a more dovish approach from the Fed to support growth. Turning to the Eurozone and China, we explore how weaknesses in these regions could exacerbate global economic challenges. The Eurozone has faced persistent low growth, particularly in Germany, which has struggled due to its manufacturing sector's inability to compete, high energy prices, and internal structural challenges. Italy and Spain have performed better, partly due to service sector growth and investment from EU recovery funds, but these factors may not be sustainable. China's issues stem from a housing market crisis, where significant wealth was tied up in real estate. The bursting of this bubble has led to declines in home sales and prices, damaging consumer sentiment and economic activity. Attempts by the Chinese government to redirect investment toward manufacturing have exacerbated problems, leading to oversupply and deflationary pressures. Although short-term stimulus measures have been implemented, China's long-term structural challenges remain a significant risk to global growth, potentially impacting economies like the Eurozone and the US. Overall, the interconnectedness of these economic dynamics poses serious challenges, and our analysis highlights the importance of carefully monitoring these evolving risks. Our next section will focus on the outlook for the oil market, considering geopolitical factors and historical patterns to better understand future price movements. That will require the Fed to have a more dovish stance to also compensate for the increase in the 10-year term premium due to rising riskiness. Hence, it will need to be far more dovish than what markets anticipate. To support this scenario, we look at the Eurozone and Chinese economies, from where global economic weakness could actually originate. The Eurozone has persistently recorded low growth, largely driven by Germany. The Eurozone and Germany were traditionally known for producing high-quality manufactured goods, but competition in this market has been exacerbated, partly by China, which has been producing and exporting similar goods at lower prices. German goods have struggled to compete. Additionally, Germany has suffered from high energy prices, exacerbated by the Russian invasion of Ukraine, which increased input costs and made their goods even more expensive. Consequently, Germany has struggled in export markets, which has dragged down growth. Internal weaknesses, such as a lack of innovation and productivity growth, have also hindered growth. This was highlighted in a recent report by Mario Draghi, where he emphasized that without structural reforms and economic investment in innovation and infrastructure, it would be impossible for the Eurozone to sustain high growth and remain competitive. Meanwhile, households have had negative expectations and perceptions, reducing domestic demand, which has declined for 3 quarters. This is not surprising given that despite accumulated savings, people are not spending but rather continuing to save excess wealth. Germany has been persistently declining, mainly because its manufacturing sector is underperforming, whereas traditionally service-oriented countries like Italy and Spain have been outperforming in terms of growth. Spain, in particular, has shown remarkable performance, driven by rising service exports, especially from tourism, though this might not be sustainable in the long term. Italy and Spain have also benefited from EU next-generation funds, which have allowed for investments in infrastructure and long-term assets. The divergence between manufacturing and services is evident in PMIs and reflects changing spending patterns, with more being spent on services and less on manufactured goods. This divergence also affects inflation measures, where goods inflation has moderated, dragging down headline numbers. Consequently, ECB officials have remained relatively optimistic, even cutting rates as inflation appeared anchored. However, underlying pressures persist. Wage growth remains above a sustainable level, indicating a tight labor market, which keeps service inflation elevated. Core inflation in the Eurozone remains around 4%, above the target, posing a risk that central bankers must consider when calibrating policy. In short, the Eurozone is grappling with slow growth and high service inflation, a stagflation-like environment that is difficult to navigate. As for China, it has been increasing its global market share in non-energy goods exports since 2010. While the Eurozone, Germany, and the US have struggled to keep up. This situation has intensified China's own economic challenges, which began with property market weaknesses. Chinese asset holdings have been heavily concentrated in housing, with people buying multiple properties in anticipation of rising values. Eventually, this bubble burst, exacerbated by COVID-19 and the damaging effects of the zero-COVID policy, hurting economic growth. House prices and new home sales have persistently declined, eroding household wealth and damaging economic sentiment. Some Chinese real estate companies have defaulted, further exacerbating the issue. The government's attempts to redirect investment from property to manufacturing have compounded the problem, resulting in excess capacity in manufactured goods without sufficient demand, leading to falling producer prices. While the world experienced high inflation in 2022 and 2023, Chinese producers faced losses as their input costs remained high, but the prices of their goods declined. The Shanghai Composite Index has been historically low, and although stimulus measures have temporarily boosted stock prices, China's unsustainable debt levels complicate the possibility of aggressive fiscal intervention. These measures may stabilize markets in the short term, but long-term solutions require structural reforms and a shift from a supply-driven to a demand-driven growth model. Low retail sales and persistent economic sluggishness may prevent China from achieving its 5% growth target, posing a significant risk to the global economy. This could reduce global demand, affecting the Eurozone, especially Germany, which exports around 35% of its goods to China. Declining Chinese demand could exacerbate weaknesses in the Eurozone and affect the US economy, potentially triggering a global economic slowdown or recession. Given China's significance, as it accounts for about 16% of global oil consumption, a decline in Chinese demand could also impact oil prices. Next, we turn to the oil market outlook. We aim to approach this issue from a historical perspective, considering various factors rather than solely relying on empirical techniques. For instance, Lutz Kilian's paper suggests that oil supply shocks have little impact on prices, but historical evidence shows that supply shortages can lead to significant price increases. Therefore, one must interpret such empirical results cautiously. Several risks could influence oil prices. The Middle East conflict is a potential threat, and if Iran's oil fields were taken out, Saudi Arabia might attempt to partially offset the impact using OPEC's spare capacity. But this declining oil supply could drive the economy below its spare capacity, which might result in a surge in oil prices or an increase in the oil price outlook. This potential surge could significantly affect not only inflation dynamics but also global growth prospects. In a case B-type scenario, weaker global growth driven by economic downturns in China and the Eurozone could reduce oil demand, leading to a decline in oil prices. For now, it appears that the case B scenario has a stronger influence on the global oil outlook. Nevertheless, there are risks to consider, particularly regarding the implications of case A. This graph shows the relationship between OPEC's spare capacity and oil prices. It's crucial to understand that when spare capacity drops below 2 million barrels, the oil market is considered tight. For example, before the global financial crisis, GFC, China's entry into the World Trade Organization fueled rapid economic growth and significantly increased oil demand. During this period, the oil market had very low spare capacity, which resulted in a dramatic rise in oil prices, surging from around $30 per barrel to approximately $120 per barrel. This had profound consequences for production capacity, economic growth, and energy prices. Considering a potential scenario involving Iran, if sanctions are imposed or Iran's oil fields are taken out of production, spare capacity could drop to around 2 million barrels or lower, tightening the market even further. Even if OPEC tries to compensate for the lost Iranian supply, spare capacity would still remain low, making the oil market extremely vulnerable to any unexpected increase in demand. Additionally, Saudi Arabia is facing challenges as extracting oil becomes increasingly difficult and costly. Now, focusing on the Iran scenario, we must consider how oil prices and the global economy are interlinked. A study by Armen Nobekian, Doug, and other co-authors analyzed oil prices from historical and economic perspectives, considering the effects of both temporary and permanent supply shocks. Both types of shocks initially reduce oil production, but temporary supply shocks recover over time, while permanent shocks do not. The forward-looking nature of the oil market means that a permanent supply shock would lead to a more significant and sustained increase in oil prices, with more severe consequences for real GDP, as oil shortages hinder production and keep prices elevated. If Iran's 2 million barrels of oil are removed from the market, OPEC may attempt to compensate with a temporary increase in supply. However, this strategy is unsustainable in the long term. Eventually, global oil production would experience a permanent reduction, causing oil prices to rise significantly and making the global economy susceptible to unexpected demand surges. Real GDP would likely suffer due to persistent oil shortages and their impact on production processes. However, it is important to consider the role of US shale oil, which could mitigate the severity of this scenario compared to the pre-GFC period. Nevertheless, uncertainties remain, particularly regarding whether China's economic weakness will offset the potential rise in oil prices by reducing demand more than the drop in supply. Moving on to global growth projections. We anticipate around 3% growth in both 2025 and 2026, consistent with the World Economic Outlook's baseline scenario. However, the risks lean more toward a case A scenario involving inflationary pressures. This could be driven by a gradual soft landing, where growth moderates around 3%. Additionally, advancements in AI could boost medium-term growth and contribute to asset price bubbles, further fueling consumption and inflation. In case A, higher growth might persist, with excess demand pressures and a higher neutral interest rate. Conversely, in case B, weakness in the Eurozone and China could lead to a stock market correction and a minor recession in advanced economies, reducing global growth by about 0.6 percentage points in 2025 and persisting into 2026. In the United States, growth is expected to converge to around 2% by 2025 and 1.9% by 2026, reflecting a gradual moderation. Case A could see growth 0.3 percentage points higher in 2025 and 0.1 percentage points higher in 2026, while Case B could result in a 2.2 percentage point drop, potentially causing a mild recession. The scenarios for inflation and unemployment are consistent. In Case A, unemployment would remain below the natural rate, sustaining inflationary pressures. In the baseline scenario, unemployment would converge to the natural rate, with inflation gradually moderating. In Case B, higher unemployment from a recessionary environment would accelerate inflation's return to target levels. In China, the baseline scenario predicts modest growth of around 4.6–4.7%, driven by the government's efforts to restore confidence. Case A could lead to 0.6 percentage points higher growth in 2025 and 0.1 percentage point higher in 2026. However, the more likely Case B scenario involves further deterioration in the housing market, tightening credit conditions, and the government's inability to contain the crisis. This could reduce growth by 1.6 percentage points in 2025 and 0.3 percentage points in 2026. Thank you for your attention. Stay tuned for further updates.